If you've ever felt lost when people talk about investing, or if you've been putting off learning because it seems too complicated, this video is for you. I'm going to break down everything you need to know to start investing in plain English, with no confusing jargon. By the end of this video, you'll understand exactly what investing is, why it matters, and how to get started today. What is investing? Let's start with the basics. Investing is simply putting your money to work for you. Instead of letting cash sit in a checking account, you're using it to buy assets that have the potential to grow in value over time. Think of it this way. If you keep $1,000 under your mattress for 10 years, you'll still have $1,000. But because of inflation, that money will buy less than it does today. If you invest that same $1,000, it could grow to $1,500, $2,000, or even more, depending on how you invest it. The key difference between saving and investing is time and purpose. Savings are for short-term goals and emergencies, money you might need in the next few years. Investing is for long-term goals, usually 5 years or more into the future. Why you should start now? Here's the most powerful concept in investing: compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. When you invest money and it grows, you earn returns. Then those returns start earning their own returns. It's like a snowball rolling down a hill, getting bigger and bigger. The earlier you start, the more time your money has to compound. Let's look at a real example. If you invest $5,000 at age 25 and never add another penny, assuming an average return of 7% annually, you'd have over $76,000 by age 65. But if you wait until 35 to invest that same $5,000, you'd only have about $38,000 by 65. That 10-year delay cost you nearly $40,000. Understanding risk and return. Before we dive into how to invest, you need to understand the relationship between risk and return. Generally, investments with higher potential returns come with higher risk. Risk means the possibility of losing money or experiencing volatility. Stocks are riskier than bonds, but historically they've provided better returns over long periods. Real estate, cryptocurrencies, and commodities all have different risk-return profiles. The key is finding the right balance for your situation. Your risk tolerance depends on several factors: your age, income stability, financial goals, and honestly, how well you sleep at night when markets are down. Younger investors can typically afford to take more risk because they have decades to recover from market downturns. Types of investments. There are 4 main types of investments beginners should know about. First, stocks. When you buy a stock, you're buying a small piece of a company. If the company does well, your stock value increases. Companies may also pay dividends, which are cash payments to shareholders. Stocks have historically returned about 10% annually over the long term, but they can be volatile in the short term. Second, mutual funds and ETFs. These are collections of stocks, bonds, or other assets bundled together. Instead of buying individual stocks, you're buying a diversified basket. ETFs, or exchange-traded funds, are similar to mutual funds but trade like stocks throughout the day. These are perfect for beginners because they provide instant diversification. Third, index funds. These are a special type of mutual fund or ETF that tracks a market index. They're incredibly popular because they're low cost and have consistently outperformed most actively managed funds over time. How to get started. Now for the practical stuff. Here's your step-by-step plan to start investing. Step 1. Get your financial foundation in order. Before investing, make sure you have an emergency fund with 3 to 6 months of expenses. Pay off high-interest debt like credit cards. There's no investment that reliably beats the 20% interest you're paying on credit card debt. Step 2. Open an investment account. For most beginners, this means opening a brokerage account. Popular options include Vanguard, Fidelity, Charles Schwab, and newer platforms like Robinhood or Webull. Most have no minimum deposits and charge 0 commissions on stock and ETF trades. You can find a link to open an investment account below in the description. If you have access to a 401k through your employer, especially one with matching contributions, that's your best starting point. That employer match is literally free money. Step 3. Decide on your investment strategy. For beginners, I strongly recommend starting with index funds. A simple portfolio might be 70% in a total stock market index fund and 30% in a total bond market index fund. As you get older, you gradually shift more into bonds. Many experts recommend target date retirement funds, which automatically adjust this balance for you based on when you plan to retire. Step 4. Start small and be consistent. You don't need thousands of dollars to begin. Many platforms let you start with as little as $1. The key is consistency. Set up automatic investments every month, even if it's just $50 or $100. This strategy, called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, reducing your overall risk. Common mistakes to avoid. Let me save you from the mistakes most beginners make. Don't try to time the market. Nobody can consistently predict market highs and lows. Time in the market beats timing the market every single time. Don't put all your eggs in one basket. Diversification protects you when individual investments fail. Spread your money across different types of investments. Don't panic sell when the market drops. Market downturns are normal and temporary. If you sell when everything's down, you lock in those losses. History shows that markets always recover over the long term. Don't ignore fees. A 1% fee might not sound like much, but over 30 years, it could cost you hundreds of thousands of dollars in lost returns. Choose low-cost index funds whenever possible. Final thoughts. Investing isn't about getting rich quick. It's about building wealth slowly and steadily over time. The best time to start was yesterday. The second best time is today. You don't need to be an expert or have a lot of money. You just need to start, stay consistent, and let time do the heavy lifting. Open that account this week. Set up automatic contributions. Choose a simple index fund. Then let it grow. Your future self will thank you for taking action today. If you found this helpful, hit that subscribe button for more practical money advice. Now stop watching and go open that investment account.